Hi, and welcome to Westpac London's end of day report for Friday, September the 30th, end of quarter report as well. Okay, what I'll do first is just run through the main events of the day, and then we'll run through markets. It actually started off the negative sentiment in European equity markets today because of confirmation that for the third month running, an indicator of Chinese manufacturing activity actually was contracting, and this is an indicator prepared by HSBC that accurately told us that China had difficulties back in late 2008. So it's got some credibility, and confirmation of that third sub 50 or contractionary reading put a bit of a negative spin on the Chinese economic story, which has had a few disappointments of late. There's another concern about China is the property market overheating. A lot of reports about that in the press today. But then we moved on to Europe, where we had a very steep fall, a 2.9% fall in retail sales in Germany. Now, I don't trust these retail numbers at all. They've changed the series dramatically this year, changed the stores they sample. And there's been some wild swings, like up 4% a couple of months ago, now down almost 3%. But markets seem to have, hung their hat on this figure and sold off the German market quite sharply because of it. We also had a much higher than expected inflation number in the flash estimate for September for all of Euroland. It rose from 2.5 to 3%. It had been drifting a little bit lower in prior months. It could be actually that the austerity measures in some parts of Europe, actually, which include higher taxes and higher charges and so on, that could be actually being captured by the CPI. But we won't know for sure until we see the final figures in the middle of October. That's when we get more detailed national data and also the final European figures with some breakdown. Certainly the German figures that we saw earlier this week did show a bit of a blip high, but any German jumps in inflation don't always translate into European ones, so that was a bit of a surprise today. Then moving on to the US economy, we had figures which showed for only the second month this year a 0.1% rise in the core PCE deflator, which is one of the Fed's preferred measures of inflation. It's not hardly going to reignite deflationary concerns, given that last year we had 11 readings of 0.1% or lower on that measure, and I think it was 8 out of 12 in 2009 of 0.1% or lower. But nevertheless, with one of the Fed officials, I think it was Bullard, recently talking about that he's keeping an eye on the deflation risks, given that inflation expectations on some measures have been declining in America. It made markets sit up and notice, particularly given that other parts of the report were very soft. We saw a rare fall in personal income. In fact, in the month of August, and in fact, with the July number revised down for personal income growth, basically the back-to-back numbers for July-August were the weakest since the middle of 2009, when of course the economy in the US was at its absolute low point and when jobs were still being shed. So that was a pretty weak report. And combined with all the other numbers we've seen in Germany, even though we don't rely on them so much, the European inflation numbers and also the Chinese numbers, that means that US markets opened fairly bearishly when they started trading some hours ago. Later on in the US session, however, we had figures on a Chicago business survey, which I'm not a big fan of, but it actually was pretty strong, so I don't believe it, and a revision upwards to consumer sentiment, only a slight revision upwards relative to the huge losses on that measure we've seen over the last few months, but nevertheless those two reports were positively received, and that's changed the vibe in US markets somewhat. But as I speak, and I'm speaking at the European close, we've got the FTSE in London down 2% today, the French markets also down 2%, and the German markets down 3% today. Adding weight to the view that those dodgy retail numbers that were at least part of the story. Also reports are coming through that the Greek Statistical Office has been barricaded by strikers, which is going to delay getting the necessary figures to the ECB, IMF and EU officials who need to make a decision on the Greek bailout on early next week. So that might have had a bit of an impact on equity market sentiment as well. That you try to help these guys and they still they just make it even more difficult to put that assistance into place. US markets, though, as I speak, are actually doing a little bit better. They're still down, but not as weak as they were, with the Dow down 0.3%. It's at 11,117. The broader S&P is down around 0.7%. As I say, this is just heading up to 5 o'clock. There's still some hours of trading to go. Commodity market sentiment's a bit negative today. We've got oil down 1% at $81.20 a barrel. Copper's down 2% at 318 cents a pound, and gold is the exception there, up 0.5% at $1,626 an ounce. Aussie dollar's a little changed. It's at 97.6 US cents. Did dip below 97 briefly earlier today, but it's been brought back to around the levels that we saw yesterday. Next week's a pretty busy one. We've got interest rate decisions from the Reserve Bank, the European Central Bank, and the Bank of England, all of whom we think are going to do something pretty soon, none of whom we think will do something next week. And we get the monthly jobs report out of the US on Friday, and also that decision on the sixth tranche of Greek bailout funds worth $8 billion. They need it before the middle of October. Okay, so plenty to talk about next week, but that's it for Friday, September the 30th.